Hello. All right, we're going to go ahead for intermediate 2 and do a quick video over the first half of the chapter 18 lecture notes. And I said quick, and it's probably not going to be, but I'll make it as quick as I can. So let me share my screen. So I do need to verify that out in Moodle, the chapter 18 blank notes are out there. So wish me luck there. It's a lot going on, right? And so let me go ahead and check that out. All right, so you do need some chapter 18 blank notes. So let me go ahead and put those out there for you right now. I know that you're watching a video and why would I record myself doing this, but if I don't do it now, I won't remember to do it. So let me go ahead and throw those out there for you. So I made a video today for my financial accounting students and it didn't work. That's the first time that's happened. So I'm kind of freaked out by it. So I remade it without them, but oh man, I didn't have time to make a video twice. It's not what I really wanted to be doing, but that's okay. And so hopefully that doesn't happen again because that stressed me out. So let me put that one out there so that those chapter 18 blank notes are there for you so that you guys can follow along with me. So let's go over here to our chapter 18 notes. This chapter is all about equity. So equity on the balance sheet is a section that includes in a corporation, common stock and retained earnings. So when we look at common stock and retained earnings, sometimes in financial accounting, we call common stock paid in capital or contributed capital. And all of those are words for that equity section that's money from owners. And so we are actually going to expand it out quite a bit from just common stock. So in advanced accounting, for those of you that are in advanced right now, we actually talked about common stock and then paid in capital in excess of par. So this chapter unpacks that concept. So you already had a preview to that in advanced, and so that should kind of help us as we figure this out. So remember that anytime a business wants to raise money, they have two broad categories, debt financing and equity financing. So you can finance your business through debt, and that would be getting loans or bonds. And you can also finance your business through equity, and that would be giving someone shares of ownership in your corporation. So the equity section has two different sections. There is money from owners, which is called paid in capital, or common stock is what you called it in financial when we were being basic, contributed capital. And then the other section is when we earn money in the business, and that's retained earnings. Now, retained earnings, you should be super comfortable with it, and it's not really going to change in this chapter. So everything you know about retained earnings is still retained earnings. So that's good. In this chapter, though, we're also going to learn how to pay dividends. So we haven't paid dividends yet much. So usually when we pay dividends, we've just debited dividends and credited cash or credited dividends payable. So we're going to get a little fancier, and instead of just paying dividends, cash dividends, maybe there'll be stock dividends and things like that. But in general, this chapter is pretty easy. It's a nice way to finish things out because we only have 2 chapters left, this one and the next one. So just some general notes about corporations, advantages. You can transfer ownership of a corporation very easily, buying and selling shares of stock. You can raise capital easier because you don't have to go find owners to say, do you want to be a partial partner in this business by contributing $100,000? You can find owners by letting them buy shares of stock for $5. And so disadvantages, double taxation and government regulation are the 2 big ones. Double taxation means that if you are a corporation, you pay corporate taxes. And so if your net income of the corporation is $100,000 and you pay 35% in taxes, you pay $35,000 in taxes. But then if you take that $100,000 of net income and you distribute it to owners, then they pay tax on that money as dividend income, and that $100,000 got taxed twice. So that's called double taxation. So just some general types of corporations. Publicly traded corporations are ones that you can buy stock for on the market. Privately held are companies like Coke and Cargill are both privately held corporations headquartered in Wichita, and 2 of the largest privately held corporations in the world. So not-for-profits are things like hospitals and things like that. And so they have a different kind of accounting, and that's what we'll learn about in fund accounting next year if you take it. So hybrid organizations, those are ones that have a little bit of different characteristics. And so a limited liability company is taxed like a partnership, but it's it has the liability features of a corporation. And so S Corps, they do have a limit to the number of owners, but they're protected like a corporation as well. Limited liability partnership is one where certain partners don't have to have full liability. So I guess that's what limited liability means. I mean, I guess I just said the words, but limited liability partnership would be like if me and Maddie and Willow decided to start a partnership and Maddie and Willow ran it and I was just a silent partner, I could just give money and I could be a limited partner. And then Maddie and at least one person has to be a general partner. So maybe we could let Willow take all of the liability and she could be a general partner and Maddie and I could be limited. And then if the partnership goes bankrupt, then Willow's name's not on it, not me. So, so that's kind of the idea of a limited liability one. So organizational costs are costs incurred to be able to start your business. Like, so right in the beginning, like how you organize your business and hire lawyers and stuff to get all the paperwork figured out and stuff like that. And so we record those as an intangible asset because they're going to benefit us in the future. Usually they have like 180 month life. This one, it says, so I've seen it over 15 years. Maybe that's when it's franchises, but organization costs can be amortized over a 5-year period too. So you debit an asset account and then you write it off over a 5-year period. There are certain times when you can expense them too though. So some of these rules have changed a little, so we'll kind of have to look into that as we go. Okay, so on the balance sheet, let's see, this is a little blurb about other comprehensive income. Remember when I said dash OCI? So when we had unrealized holding gains and losses, dash OCI. So there's a little conversation here, but we're not going to do anything with it. So, so as far as stock goes, there are 4 different definitional type things that we need to understand as it relates to common stock. So you can have a certain number of shares authorized, issued, and outstanding is the language we use. So authorized, so let's go ahead and just define these here, is the maximum number of shares you can sell or you can, I don't know, put into the market. Issued is the amount you have sold into the market. Outstanding is the amount that are currently in the market. So I skipped treasury because treasury is when you remove shares from the market. The amount of shares you have removed from the market. And we're going to learn how to do all of the entries for those. And so authorized is just the maximum number you can sell. So if I start a new business and I say, I can sell 1 million shares of $1 par value common stock. That's the amount I'm authorized to sell. And so if I go ahead and put 200,000 shares out there, I have now issued 200,000 shares and they're all outstanding. But if I decide that's too many and I pull 10 back, I can do that. I can just like log into the computer and buy 10,000 shares off out of the market. And so then I had 200,000 shares issued, but only 190,000 are outstanding. And that 10,000 that I removed from the market are treasury stock shares. And then I can put those back into the market when I'm ready. And so that's the idea of authorized, issued, and outstanding. If you remove shares from the market, that's a contra equity. Haven't had one of those yet. I'm excited. A contra equity is, it offsets your equity account. So it's a negative in the equity section. And so just like a contra asset is a negative in the asset section. So equity has a credit balance. And so, oh, I should show you my shirt. I don't know if you can read it because it's going to be backwards. It says, not slim, kind of shady. Okay, so I just happened to be standing, so I thought, oh, I'll show them my new shirt. All right, so authorized, issued, and outstanding. That's enough of that. So the reason why, like some of the rights of a shareholder is you get to right to vote in matters that relate to the corporation. So if I buy shares of stock in McDonald's, I will get notices every once in a while that would allow me to vote. And so I'll be like, bring back the McRib. I would never say that because that's disgusting. But they wouldn't ask me about that kind of stuff, but they might ask me about voting on like who should the president of the company be type situations, or who should be a member of the board of directors. Like I could elect a board of directors member, that kind of stuff. I also get a share in the profits when dividends are declared. So if I'm a stockholder and they issue a 25-cent per share dividend and I own a share, man, I'm going to get a quarter. Okay. If I own 2 shares, I'll get 50 cents. All right. And then if the business is liquidated, then I will be in line for money there too. And so the way that works is normally if a company liquidates, it might be because they're going out of business because they don't make enough money. So what happens is during liquidation, and I think we're going to practice this in advanced next week, I'm pretty sure. But what happens is the corporation will change everything they have back into cash. So they'll sell off all their equipment, they'll collect all their receivables, they'll sell off land and buildings and all that kind of stuff. They convert everything into cash, and then they've used that money to pay off all of their liabilities. Anything left over goes to the owners. So there may be no money left over, or there may be a ton of money left over, depending. And so you as an owner of McDonald's, if you had one share of stock and at the very end, they took their billions of dollars and they paid off all their liabilities and they had 1 billion left and there was 1 billion shareholders, everybody get $1. I just made those numbers up because clearly there's not 1 billion shareholders, but you get the idea. Lauren, I'm making a video.
Sorry. He's so cute.
Say hi.
Hi.
Okay, now go.
Look at him.
He is cute. Go. Okay, don't make fun of him. Okay. Okay, so there's something called preferred stockholders, and we've never really dealt with those before, but a preferred stockholder is one that has preferential treatment in a certain area. So I know you love it when I define the word with the word, but that's what we do, right? So preferred stockholders get some preferential treatment. Normally that preferential treatment is in relation to dividends. So they get their dividends first. So before anybody else gets a dividend, they get their dividend. Oh, I got to show you. Claire made me a poppy hat. So see, now I look like a troll. Yeah? Okay. Man, I'm distracted today. Tell I've had a long day. Okay. All right. So we'll talk about that as we go. The concept of par value is just referring to an arbitrary number that's assigned to shares of stock. And so if it's $1 par value, that means that when you put the money into the common stock account, you put $1 there, and anything in excess of that will go into a separate account. And so literally there's rules about keeping at least that much money in the business for the owners, but I don't think it really actually happens like that. Okay, so let's see here. This is just talking about like what we're going to debit and what we're going to credit and how we're going to put excess and paid in capital. I really want to just do it. There's a little conversation here about retained earnings, and retained earnings is when we earn money in the business and we retain it. I know, I'm doing it again. Okay, so basically when we earn net income, we have a choice. We can keep it in the business or we can pay it out as dividends. And so the formula for retained earnings that we learned on the first week of financial accounting way back in the day was beginning retained earnings plus net income minus dividends is ending retained earnings. Now in this chapter, sometimes instead of having a dividend account, they're just going to reduce retained earnings. And then I don't like to do that because I like to close the red ones. And if I put dividends directly in retained earnings, then I'd only close the red ones, and that's not even a word. And so I prefer to close my dividends separately and have an account for dividends, but you don't have to. You can just, anytime you pay a dividend, take it out of retained earnings because you're not retaining it. So you reduce retained earnings by debiting retained earnings, and that's okay to do that. So most of the time we'll pay our dividend in cash, but sometimes we may give a stock dividend. A stock dividend is when you mail shares of stock instead of mailing cash to them. So you could give like a 10% stock dividend. And so if I owned 100 shares, they would mail me 10 more shares for free. And so that's called a stock dividend. So it's usually a percentage. And there's also something called a stock split, which we'll talk about later on too. A stock split is when your shares split in half or split in thirds or whatever, and then you end up with more shares. And so basically if you have 100 shares and it's a 2-for-1 stock split, now you have 200 shares. Now, by doing that, you're putting twice as many shares out into the market. So the market price should drop. So you would want, if you wanted to maximize on the value of that, you would sell quickly and see if you can sell your shares, but everybody's going to be selling because they're trying to like get some benefit out of it. And then eventually the market price will basically drop about in half. And so, the stock split journal entry is one of our students' favorites journal entries because there is no journal entry for a stock split. You just have more shares, but no more money comes in or anything like that. So no journal entry is recorded. Okay, So I think I want to go forward. I'm still looking for journal entries. I'm ready to do some journal entries, but so far all we've had is words. And I know you guys are just like, oh my gosh. But paid in capital is the money invested by owners. Retained earnings is our earnings less dividends, and it's a running balance of all of that. Legal capital is the par value. And so basically it's the money that is normally kept within the business to provide some protection to creditors. So it can't be returned to stockholders until all the debts are paid. So it's a minimum amount in there. So outstanding versus issued versus outstanding versus treasury. And so this sentence basically explains it well. The corporation can repurchase shares back, which is called treasury stock. This stock is issued, but no longer outstanding. So this example kind of explains the concept a little bit. XYZ Corporation is authorized to sell 1 million shares of common stock. 750,000 shares have been issued. 50,000 have been reacquired. That means treasury stock. How many shares are outstanding? So 750,000 were issued, but 50,000 were removed. So our answer is 700,000. I have a lot of room, so I might as well write the word shares. Okay, so these are the rights to vote and things like that. We've already covered all of this. This is just a little bit more information on it. Remember that a corporation doesn't have to pay dividends. It's optional. So you can choose to pay dividends if you want, but you do not have to pay dividends as a corporation. Par value is that arbitrary amount. That's the amount we put in the actual common stock account or preferred stock account. Anything in excess would go in paid in capital in excess of par. PICEP is what we abbreviate that for. Paid in capital excess par. PICEP. So let's do some journal entries finally. Okay. Belson Corporation sold 1,000 shares of $10 par value common stock for $17 a share. So Belson Corporation, we are doing the journal entries for the equity side of this. And so we are Belson. We put shares out in the market. We're going to receive $17 a share. So we're going to receive cash of $1,700. I don't know what's under here. 17,000. Okay, I just can't do math. 1,000. 17,000. Thank you for that. And then common stock would be the $10 a share, and anything in excess goes in PICEP. So in common stock, we would put 10,000, the par value, and anything in excess of the par value goes in paid in capital in excess of par. So we can just abbreviate that PICEP, which I don't think that's a real word. Somebody that goes and works in accounting, use that word somewhere and see if people are like, what? Because I don't know if it's a real word. I thought it's just a word that's made up, and it's just a word I say because I'm just lazy and I don't want to write it out. But I see the abbreviation regularly. I just don't really know if there's like, if that's how you're supposed to say it. Maybe it's actually called PICEP. I don't know. So Belson sold 1,000 shares of $25 par value preferred stock for $30 a share. So now we're going to bring in 30 grand. So I'm going to debit cash for 30. But only $25 a share will go in the preferred stock account. So we've never used the preferred stock account before, but it's just like common stock. It's just another equity account. They have preferential treatment. So usually in relation to when they get their dividends. So we'll put 25,000 in preferred stock, and then we'll put the extra 5 in PICEP. And sometimes we go PICEP dash preferred stock. So the dash preferred stock just keeps track of how much PICEP is related to preferred stock. And we can also do the same thing up here and do dash common stock. So we can keep track of it separately. The only time that becomes important is when you do treasury shares. Because if you do treasury shares, you'll use up the PICEP account before you do other stuff. And we'll talk about that in a minute. So no par value common stock does not have an assigned par value. And so if that's the case, sometimes there's a stated value, which is the same thing as par value. It's just another word for it. So if it says there's no par value, we have this no par value common stock with a stated value of $1 a share, that's the par value. And so just go with that. And then sometimes there's just literally no par value or stated value, and then you just have to put it all in common stock because you can't have an excess of par value if there's no par value. So 100 shares of no par preferred stock for $50 a share. You're just going to say 100 times 50, and you know I can't do that math, 5,000, and we're just going to debit cash and credit preferred stock. That's 50. And I think I'm right this time. Okay. Maybe I was right before too. Okay, so 5,000. Okay, so then it says Camden Corporation also issued 500 shares of common stock with a stated value of 5 for $7 a share. So 500 times $7 a share is 3,500. Okay, and then we're going to put in the common stock account the par value or stated value, same concept. So the stated value of $5 a share. So we'll put 2,500 in common stock and we'll put the other 1,000 in paid in capital and excess of par, PISEP. And again, you can do dash common stock if you want. We should probably just get in the habit of doing that because it doesn't hurt to do that. So if you're doing this in real life, if there is different PISEP accounts for common stock and preferred stock, keep track of it like that. If there's not, don't. So, okay, did you hear the sound of my email? I wanted to go check it. That's why I don't ever get anything done. Okay, Camden Corporation also issued 1,000 shares of $5 stated value common stock in exchange for some equipment with a fair value of $8,500. All right, this is a little trickier. So basically Camden doesn't have any money, but they need some equipment. So they go to the equipment store and they're like, hey, what up? I need some equipment, but I don't have any money. Do you want some shares of my stock? And they were like, yeah. Okay, so we bought some equipment. We know the value of the equipment. So we have to debit equipment for $8,500 because that's a known number. The equipment regularly in the market sells for $8,500. So I'm going to debit equipment for $8,500. The 1,000 shares at $5 stated value mean that I'm going to put 5,000 of that in common stock. And then the other 3,500 will go in paid in capital in excess of par. Okay, so now here's some more practice questions. So let's keep going. So it says, prepare the appropriate journal entries to record each transaction. So we are Yankee. We are authorized to issue 240 million shares of common stock, dollar par value, and 30 million shares of preferred stock, $50 par value. So notice the preferred stock is more expensive. It's because they get dividends first and those kinds of things. And so, and they'll sell for more later too. So if you wanted to sell your preferred stock shares, they sell for a higher amount. So there's fewer of them. So they're not the common people, they're the preferred people. Okay. So let's go ahead. First on 213 sold 60 million of common shares for $10 a share. So I need to pay attention. My common shares have a dollar par value. So I'm going to put $1 times 60 million or $60 million in the common stock account, and the rest will go in paid in capital in excess of par. So a lot of excess there. Okay. So you okay there? Yeah. Okay. All right. So again, we only put the par value here, and that's $1. And so that's why we put $1 there for times 60 million. On 214, we're going to sell 1 million shares to attorneys in exchange for legal services. So we're not selling shares. We're not going to get any money in this situation. But we are going to give them 1 million shares. Now, one thing to consider is yesterday, the value of shares was $10 a share. So we have to consider that same concept. So I'm going to skip a row. And in the second row, I'm going to put common stock of 1 million in excess of 9 million, because that makes sense. Okay, because shares were selling for $10 a share yesterday. So when I give shares to attorneys, it must be worth $10 a share. So then my debit will be for 10 million. Okay, and so here we would use either legal expense or organizational cost, just depending. And I think usually I'll have you use legal expense. Sometimes they make you amortize that, but if you don't have to, if it's under a certain dollar amount, they don't make you, and I can't remember what that is. But okay, so February 14th, we're going to sell 3 million of our common shares and 1 million of our preferred shares for 90 million. Okay, so this one's kind of fun because we know we're going to receive 90 million. All right, so we received 90 million. And so the question is, how many shares are common? How many shares are preferred? How much goes in PISEP for common and how much goes in PISEP for preferred? Keep in mind that yesterday, our shares were selling for $10 a share for common shares. I have no idea what the preferred shares sell for. I do know the par value though. So what I'm gonna do, I'm gonna delete it. And then I'm going to do this from scratch just to make sure that this makes sense. So the first thing I want to do is I want to credit common stock. I'm also going to credit PISEP for common stock. I'm also going to credit preferred stock. And I'm also going to credit PISEP for preferred stock. So common stock was 3 million shares. and the common stock has $1 par value. So I'm going to put, did they say 3 million shares? Okay. And then in preferred stock, it's 1 million shares, but those have a par value of $50 a share. So I'm going to put 50. Oops, sorry. I think I'm in the wrong place. Good grief, Nicole Lynn. Okay, 3. So common stock is going to be the par value. So the par value is $1. Okay, but the excess from above was $9 a share. Because remember that our common shares were selling for $10 a share. So our common shares yesterday were selling for $10 a share, so that must be the value of our common shares. So here it's 3 million shares at $9 a share, so I'm going to put 27 million there. Okay. For preferred stock, it's 1 million shares at $50 per share, so that will be 50 million is going to go in preferred stock. And then this will be a plug. So the rest of it goes there, because I don't know what my preferred shares regularly sell for, because I haven't sold any lately and I don't have any access to records on what the values of them are or anything like that. But this is an absolute and this is an absolute. So the par value. So the preferred par value here is $50 per share. And so now that I've found everything else, I can just solve for the other. So 90 minus 3 minus 27 minus 50 means I'm going to put 10 right here. So that was fun. And then on November 16th, we are going to issue 190,000 of its common shares in exchange for equipment for which the cash price was known to be $1,844,000. So I was looking for some known because I was hopeful that they would tell me like what the excess was, because I know it's 190,000 shares. So what I'm going to do there is I'm going to put my equipment. My equipment is known, $1,844,000. So I'll put $1,844,000 there, and it's 190,000 shares. So the dollar par value, I'm just going to put 190,000 in common stock, and everything else goes in the rest in the PICEP account. Okay. All right. So next concept is treasury stock. So when we're looking at treasury stock, remember I mentioned earlier that it's a contra equity. So it's the opposite of an equity. It offsets your equity. It's a minus in your equity section. So one thing to keep in mind, the corporation doesn't pay dividends on their treasury stock. They don't get to pay dividends to themselves. So that would allow you to manipulate your financials by removing shares from the market and then paying yourself a dividend to try to make things look better or whatever. And so they don't let you pay dividends on treasury stock. So you don't get to vote because you're not trying to sway the vote or remove votes. You're removing votes, but you don't get a vote in yourself. So, and you also don't get to recognize any gains and losses on the sale of treasury stock. So basically, a corporation does not purchase their own stock as an investment. It's not an asset. If you buy your own stock out of the market, it's a contra equity. So why would a company do this? Like, what's the purpose? Well, one of the reasons why is, remember, I don't know crap about economics, but I do know that supply and demand, if the stock prices are kind of low and you want to bring them up, if you remove shares from the market, if there's less shares out there, that will increase the demand, which should help bring up the price. So that's one way. That's one reason why. Maybe you want to give your employees a stock bonus, and so you buy some shares out of the market and then you give them to your employees or you give them to your executives. So all those things are potential reasons why you might do that. So treasury stock is our only stock account that will not be reported at par. So remember how we kept doing the par value and the excess, the par value and the excess? You don't do that with treasury shares. You record them at cost. And then from there, when you remove them at cost, or when you put them back in the market. So let's practice that concept. All right. Lowry purchased 1,000 of their own shares of $5 par value common stock for $10 a share. So we're buying our own shares out of the market. So we are going to have to pay cash to do such a thing. So 1,000 shares at $10 a share, that better be 10,000, right? and we're going to debit treasury stock. Treasury stock is a new account for us. It has a debit balance because it's a contra equity. All right, so then we're going to sell 100 of those shares of treasury stock at $12 a share. So we see that we bought them out of the market for 10. Now we're selling them for 12. So we made money. We made profit, but it's not profit. It's not profit. We cannot record gains on our treasury stock or losses on our treasury stock because we could purposely do things to manipulate our own financials, and that's not allowed. So what we're going to do is we're going to, so we're going to sell the shares for $12 a share, so 100 of them. So we're going to bring in cash of $1,200. Okay, so that's a good absolute. Now, how many shares is that? 100. And so when we bought those shares out of the market, we did not use a par value. We used the $10 a share, the cost. So I'm going to put $10 a share out of treasury stock. Okay, so here, and then here we have some excess. So that $200 excess is not gain on sale of treasury stock. That's what you'd like to put. That's what you'd be tempted to put. If I wouldn't have told you what to do with it, that would have been your go-to. And if we were sitting in class, I might have made you kind of come up with a go-to there, but we're not. I'm here by myself in my bedroom. So here I am, and I'm telling you. So you would want to put gain on sale of treasury stock, but we can't do that. So what we do is we just record PISEP. So basically it's just extra money from owners. We sold those shares back into the market and we got $2 extra a share. So we got an extra $200 and we're going to do PISEP dash treasury shares. Okay. So this number does not go on the income statement. Okay. This is just another equity. You can't record gains and losses on sales of treasury stock. It's just additional investments by owners. So now let's go ahead and sell 1,000 shares at $7 a share. So this is a good one. So we're going to sell shares in the market and it's 100 shares at $7 a share. So we're going to bring in cash of 700. Okay. So what we have to do now is what it feels like is that's a loss because when you sold it in the market, or when you bought them out of the market, you paid $10 a share and now you're selling them for $7. So what we have to do is the first thing we will do is we're going to remove the shares at $10 a share. So my credit to treasury stock is going to be $1,000. Okay. So I'm going to have a credit of 1,000. And so what I'll do, and I don't know in what order, but my guess is the treasury stock is on that last row because I think it's my only credit. So what I have is I've got 2 more debits. Okay. So I would show you that and then make you make some guesses on what we're going to do here. So what we're going to do here is the 1,000, this is at cost. So this one is always at cost, which is $10 per share. This was the $7 a share we sold it for. So the first thing we're going to do is we're going to eliminate the PISEP treasury stock. So PISEP treasury stock had a balance of 200 in it, and we're going to get rid of that. So it's an uninvestment in PISEP. And so we will debit PISEP treasury stock. And then our last debit is going to be just retained earnings. Okay. So we're going to, what I wanted to use was PISEP common stock. And that's what I'm always tempted to use. But GAAP requires that you go ahead and remove that from retained earnings. So it's kind of like a loss, but it doesn't go on the income statement. It's a reduction to equity. Okay. So that's how you handle that. So on 5103, Photos in a Second reacquired 3,000 shares of its common stock at $55 a share. And then they reissued 1,000 at 75. Which of the following would be included in the 12-3 entry? Oh, it's a multiple choice question. Well, that's fun. Okay, so let's go ahead and go somewhere blank. And let's go ahead and try to work that question. Oh, here, first I need to hit that. Okay, I need more room. I don't know what's going on with that. Here, let's keep going. Okay, so the original entry on 5-1 of 03 would be, it says we reacquired 3,000 shares of our common stock at $55 a share. So I know that's really little, I'll make it bigger. So cash, $55 a share, 3,000 shares. Treasury stock, So that would be the entry on 5/1. And then our entry on 12/3/04, it says we're going to put 1,000 of those shares back in the market at 75. So I do know my cash is 1,000 shares at 75. And my treasury stock needs removed at cost. Thank you, brother. So let me give myself some room there because I'm going to put the cost here. So remember that this cost, and we would keep track of it, was $55 per share. So when I remove it, I'm going to remove it at $55 a share. Okay. So 55 times 1,000 shares, and that difference of 20,000 will go in PICEP-treasury stock. So let's see what the question says. It says, which of the following would be included in the 12/3 entry? A credit to cash? No, we debited cash. A debit to treasury stock? No, we credited treasury stock. A credit to treasury stock for 55. Yeah, that's it. Letter C. Yep. Okay, so our answer here is letter C. That's fun. Okay, let's go ahead and let's do one more problem and then I'll stop for the day. Brand Storage Company Articles of Incorporation authorized the issuance of 520 million common shares. The transactions described below affect changes in outstanding shares prior to the transactions we had. Okay, so we have 520 million shares that were authorized. We have issued 400 million, okay? And outstanding appears to be 400 million as well. So assuming that Brand retires shares, it reacquires, which means, so if they retire shares, it restores it back to authorized but unissued. So that means that they're not going to hold them as treasury shares. They are becoming unissued. Okay, so that's a new scenario for us. Record each of the transactions. On January 8, we reacquired 8 million shares at $6 per share. So that means that we're going to pay 48 million. And we have to remove the shares. So I'm going to debit my common stock account for the par value, and then we'll use the PICEP as a reduction. So let me just delete this. Okay, so let's just talk about it. Okay, so 8 million shares, dollar par value means $1 goes there. So what happens is we can reduce our PICEP proportionately. So we have 1,200 million. I don't know how many that is, a lot. We have 1,200 million in PICEP out of 400 million. So it looks like when we were selling shares, we have an extra 3 per share in the PICEP account. So we can take out some of the PICEP. So we can remove some of the PICEP when we undo shares. When we remove shares, we're going to remove a proportionate amount of PICEP. The difference, though, can go to retained earnings. It cannot go to loss on sale or gain on sale or any of those things. All you can do is use equity accounts for these problems. So now let's go ahead and let's reacquire 16 million shares at $3.50 a share. So again, we're buying them out of the market. 16 million times 350 is 56 million. Okay. And so then from there, it's 16 million shares. So common stock's going to be 16 million. Okay. And so then from there, things are just getting worse, right? So we only have, like, we removed 24 from there, but we still have an average of $3 a share in there. So $3 times 16 is what we're going to put in PICEP. Okay, so $3 a share times 16 goes there, and then this is a plug. So retained earnings will be a plug to make this work. What do we have? Oh, is this going to be a credit? 16 plus 48, so I've got 64. So I actually need a credit rather than a debit, okay? And so that will then go into PICEP for reacquired shares. And so this would be like PICEP-treasury stock, but it's for reacquired shares. So notice that when we did badly, like when we reacquired and paid a lot, we put the difference to retained earnings. But when we have too much, we actually put it in a separate PICEP account. And then when we when we sell reacquired shares or whatever, like later on, we can have this account and we can use that account to wipe out something that happens like this. So next time we reacquire shares, instead of debiting PICEP common stock and retained earnings, we can use up this PICEP. So then on July 26th, Brand sold 12 million common shares at $7 a share. So this is a completely separate transaction that has nothing to do with our treasury stock. We didn't have treasury stock, but reacquired shares. So we are going to bring in 12 million times 7, not bring in, pay out. We're going to pay cash. Oh, wait. Okay, we're selling shares. We are Brand. We're selling shares. We are going to bring in, what did I say that number was? 84? 84 million. We're only going to put the par value in common stock. So it's 12 million shares at $7 a share. So $1 will go in common stock. So 12 million will go in common stock because it's $1 a share. And then all of our excess will go in PICEP-common stock. So, okay, so this is a decent place to stop. The next thing we're going to do is we're going to start paying dividends. So we're going to do cumulative versus non-cumulative when we're talking about our preferred dividends. And so we'll stop there. So you're ready for the first half of the chapter 18 homework. I hope you guys are doing well, and I'll talk to you soon.